Hello everyone. So welcome to one more video on the topic of bonds, long-term liabilities. Okay. So this is the fourth video in the playlist. So if you are directly coming to this video, I request you to go to my YouTube channel and find a playlist called bonds, long-term liabilities, and you start seeing the videos from the part 1, part 2, part 3 like that. And this is the fourth video. So in this we are going to solve a problem that is taken from the textbook. So let's look at this thing. So you can have a look at the question and you try to understand what is there in the question and you try to address it yourself, and otherwise I will try to solve it anyway. So you can compare your answer with my answer. Okay, so let's look at this. Okay, so what is there in this question? Okay, so the question is Xi'an Corporation issues 500,000 5 years 12% bonds at 96. So 96 means 96% or 4% discount with interest payable on January 1st. Okay, so this bond is issued on January 1st and interest payable is also on January 1st. The entry on December 31 to record the accrued bond interest and the amortization of bond discount using the straight line method will include a following entry. Okay, so there are 4 entries given. So which entry will be there? But anyway, let's try to do this journal entry for the accrued interest. Okay, so first thing what we have to do is first, what is the face value? So face value is $500,000. This is the face value. Then what is the discount? So that is 96. Okay, so that means 4% discount or at 96. Okay, so like that. So if that is the case, then what is the cash received? So cash received will be 96% of 500,000. Okay, so let's do that. So 500,000 into 0.96. So 4,80,000. Okay, or $480,000. Okay, so this is the cash received, and the difference between these two is the discount amount. Okay, so discount on bonds, that is 500 minus 480, so that will be $20,000. Okay, so what is the duration of bond? So duration of bond is 5 years. Okay, so if you look in the question, it is 5 years. Okay, so for a 5 years duration, so what will be the amortization on discount? So that will be 20,000 divided by 5. So that will be $4,000. Okay, so per year. So every year you amortize 4,000 from the discount. Okay, so that you will be by the end of 5 years, the entire discount is amortized and only the face value remains. Okay, so face value is 500,000. Okay, so now what will be the, see, we know the amortization amount, right? Now what will be the interest? Okay, so interest. Okay, so at what is the interest rate? 12%. Okay, so in the question, so it is given interest is 12%. Okay, so interest at 12% per annum. So what will be that? That will be 500,000 face value multiplied by 12%, 0.12. Okay, so how much is the interest? So 500,000.12. So $60,000 is the interest expense. Okay, so $60,000. Okay. So given this information, now I know the interest amount, I know the amortization amount, so I can make a journal entry. Okay, so what is that? Journal entry for journal entry on December 31st. Okay, so that is the journal entry. So let's do that. So anyway, December 31st will be here. Now if you look at the sample, so in the first video I have given you the sample, right? So go back to that sample. Okay. So here we have what you call issued at a discount 96%. So look at the journal entry, sample journal entry of issuing a bond at discount. So the first one is the issuing bond itself. We are not interested. Here we are interested. Interest expense will be debit. Okay, so let's do that. Interest expense, that will be debit. Okay, and credit. Okay, so what will be credit? Okay, so this amount will come back to that later. Meanwhile, I have two things. One is interest payable and discount on bonds. So discounts on bond payable. So this we already calculated. Interest payable is 60,000. Just now we calculated that interest payable is 60,000. Similarly, the amortization on discount is 4,000. Okay, so that one is here 4,000. So therefore, the interest expense will be recorded as 64,000. Okay, so this is the journal entry for the December 31st. Okay, so now you look at the choices. Okay, first what we are having, debit to interest expense 57,600, 57,600. So this is wrong option because interest expense 64,000 is the debit. Okay, so next one, debit to interest expense 60,000. Okay, so that is also not correct. Next one we have credit to discount. Okay, so credit to discount on bonds payable 4,000. So discount on bonds payable for exactly. So this we are having credit of 4,000 under discount on bonds payable. So C option is correct, and the D option, credit to discount on bond payable to 2,000, not correct. So here the correct answer is C. Okay, so like this we can find the correct answer. If you look at the next question, so again you can have a look at this question. You can try for the bonds issued in question 16. What carrying value of the bond at the end of the third interest period? What is the carrying value at the end of the third interest period? Okay, so let us draw the diagram. Okay, so what is the carrying value? Okay, so the final carrying value will be equal to face value, because we are talking about the, see, if I look at this diagram, see this same diagram they are asking. Okay, so this is the 0th year, first year, second year, third year, fourth year and fifth year. Luckily this is also 5 year, and we know it is 4,000, right? So here it was 480,000. So this is what we calculated. See, cash received is 480,000. Okay, so that one. So every year it will increase by 4,000. Okay, so here it will become 484,000. Here it will become 488,000. Here it will become 492,000. Here it will become 496,000, and next it will become 500,000. So at every year the carrying value keeps on increasing, and finally it becomes equal to the face value at the end of the 5 years. Okay, so this is the answer. At the end of the third year we are getting 492,000. So again, if you see here, so the answer is A. Okay, so that is the carrying value at the end of the third period. Okay, so I tried to collect some problems on this particular subject, and main, if I once again review this thing, the main important concepts are here. Okay, so first thing, again review, why bond is done because company receives the bond money and company pays interest, and at the end of the maturity company pays the face value back to the investor, and the investor is happy, company is happy, everybody is happy. So this is the bond concept. Now in the concept is difference is face value. Okay, so here how the journal entries are made, you can pause the video and look at this sample journal entries when the bond is issued at a face value. Similarly, you can see here the balance sheet of the company when the bond is issued at the face value. Now coming to bond issued at a discount. When the bond is issued at a discount, So what happens, the initial cash you will get less amount of cash, but the remaining payments exactly same as this one. So this part is exactly same. All the interest rates are on face value and the final payment is also on the face value to the investor. So here the why this company issues a discount, because to attract the investor. Okay, so sometimes nobody is investing in the company. To attract the investor, they give discount and the investor pays a discounted amount and enjoys the benefit of more interest and all. So this is how it is shown in the balance sheet, and this is how the journal entries are made. This is very important, and this is how is the amortization is done. Okay, so similarly, now coming to issuing bond at a premium. So this 100 here, instead of 100% face value, here it is 1 or 2% of the face value. So in that case, the investor pays more and receives the same amount as the earlier case. And this is how it is recorded in the balance sheet, and this is how the transactions are recorded in the journal entries. Okay? And this is how the amortization happens. Okay? So anyway, so we have solved one problem, and these were the journal entries. We have solved another problem, and these were the journal entries and sample balance sheet. So if you understand the concept, the other things are kind of fall into the step. So if you have the reference, so you can see which case applies, and according to that you do the thing. Okay, so we tried to solve some problems. I hope this thing helps. Now here there are certain questions. Okay, so what happens if the company wants to call back the bond in the middle of the, like at the end of the 3 years? Now I don't want to wait until 5 years and pay 500,000. I just want to, now company is willing to close the thing, then they will negotiate a price, and according to that company pays to the investor, and from there it will be stopped. Okay, so that is also possible. In that case, this amount will be useful to refer. So that point, anyway, we are not addressing that point in our video right now. Maybe in future I can make more videos on this playlist, but as of today, this is my ending video on this particular playlist. Hope this was useful for you all. So try to look for more problems from your textbook and try to address them, and all the best for your studies. Thank you.